The worldwide everything bubble is ripping faces off, and it's only going to get even hotter. Let's check out the data, the charts, wrapping up the week in finances across the stock market, real estate cycle, and of course, Bitcoin and cryptos, as they too are also ripping faces off at this stage in the cycle. Now, I've talked a lot about ripping faces off right now early on in the piece, because essentially this is going to be the hardest part of the ride. The easiest part is getting in at the start of the bubble, but of course, it's very hard to see that at the time. So I suggest you hit the like and subscribe button so you let YouTube know that you want to see more of this content in your news feed coming into this final stage of the bubble before we get that subsequent collapse from this bubble. Everything has been very much on track for this cycle, so don't go anywhere. Strap yourselves in. We got a ton to get through in today's video. Of course, it's your home of macro cycle analysis. You know the deal. Links at the top of the video description for our free TIA report so you can stay up to date with the cycles. Let's kick it off with the traditional markets, looking at the S&P 500. What happens after 4 straight months up? Now, we had the close there on Thursday for the 29th of February. Looking at 4 green months up, what happens over the next 10 months? 100% of the time, it has been green for the next 10 months. So basically going all the way through to the end of the year. And this is going to be important for the rest of the bubble as we continue to see most markets in the top 20 countries around the globe continue up, including, some might hate it, Russia after that war. Now, I just bring that up because you can really see the impact of how this bubble is forming around the globe, no matter what geopolitical things are going on in those countries. Now, most have come to realize that war can be good for the economy. I know that's a pretty old saying as well, but going back to the S&P 500, we've seen 4 green months. There was also some data I put here during the week where if we see the first 2 months of the year green, there's a very, very good chance the rest of the year is also going to see green. Now, of course, there's going to be some significant corrections along the way. That's typical of markets. You must see corrections, and sometimes they can be severe, as we'll look out for in Bitcoin and, of course, ETH as well, as they begin to go parabolic. I've got some big stuff on the ETF narrative as well that you don't want to miss. So this is 100%. I don't want to say it's always guaranteed that you see green, because at the end of the day, this is trading and investing. There are no guarantees in the market. Remember that, but the probabilities are very much on the side of a green year. Positive start, like we've seen here with the 4 straight months and also 2 months as we looked at during the year, you typically see some pretty good returns. In this case, 10 months after this point, roughly 15%. So if we saw 15% up for the S&P 500 from the end of February, that takes you to roughly around 5,800 points. So pretty decent gains still from that point after you saw January come in and close above previous all-time highs. In terms of the weekly close, had some pretty good results here again. Now, I've got some look at the corrections here along the way, because as we know from bull markets, they can get pretty grinding and pretty decent moves to the upside. And many are always looking for a significant correction. So we're very much one of the first ones to point out that there might not be those significant corrections that everyone is waiting for. Something more along the lines of 15 to 20% is far more uncommon to happen year after year. Last year, we saw a double-digit correction here of 11%. And of course, 2022 had a couple of significant corrections here, depending on where you want to measure them from. Top to low is about 15%. Now, I've just got it in black here, so there's not so many numbers screwing up with the screen. You got so many numbers all over the place. Here is roughly 18%. And then from that final move from the top to the cycle low, it was about 19%. The entire move was 27%. So as we note from these bull market runs where they do start to squeeze and squeeze and squeeze, you can see the ranges just get smaller and smaller. Even so, like we saw through the COVID boom after the collapse, which was way back down here, you've got corrections of about 11%, 9.5%, and as the tail end came in, you've also got 6% up here. But do know, like we talked about in yesterday's video, this was one of the shortest bull markets before you saw a 20% correction. So we're not expecting that this is going to play out the same this time, where you have one of the shortest bull markets. To have a short bull market after another short bull market seems even more unlikely. So we just want to follow the facts and then work the probabilities to our advantage in the markets compared to what we look at here, the majority who have expected collapses through these markets throughout 2023, and they're expecting it again in 2024. NASDAQ has also ended the week higher, new all-time high close on the weekly chart, of course, the new all-time high prices this week, and it's been tracking the previous move pretty well on point. Remember, we've been following this day after day, looking at the move from that October low to see how well it's tracking against the previous move. We want to gauge the strength and the weakness of the market here. So NASDAQ also looking very, very good. Now, the real estate cycle, you guys should know the deal. If you don't, hit that subscribe button now. For the 3 out of 10 of you that haven't, we're still looking at this market moving up. There are multiple different narratives that I've seen come out for 2024 now. And one of them was a below off top in the first half of 2024. Now, we've covered why this is probably very, very unlikely. First big reason, as I just covered earlier, is a look at the data after 4 straight months up. Typically, you'll see the rest of the year up. Now, there's many, many data points to express this. We've gone through it. I don't want to waste your time again going through each of those points. Just be sure to keep watching on the channel here. Now, the other point was the length of the bull markets, as we covered. To have one short bull market, or one of the shortest that we've seen in the last 70 years post Second World War, to be followed up by another short bull market being measured from October 2022 would seem very, very unlikely. So a blow off top in the first half of 2024 would seem very, very unlikely. We're still looking forward to the timing around 2025, 2026 for the real estate and economic cycle. The stock market could continue further. I have to keep reminding that because not everything tops at exactly the same time. You do start to see probably real estate top and then stock markets top. Then you might see gold top and maybe some commodities, and they start to play down, and then they'll all have their own little move to the upside. What happens with crypto? I think that's going to be anyone's guess, because crypto has never seen so far the end of a real estate cycle. Maybe crypto does top in 2024, has a bit of a time off, and then comes back for the later stage of the 18.6-year cycle somewhere around 2026. There's still a bit of time to go, and we'll continue to cover that on the channel here. Now, the next thing is the worldwide. I'm adding in worldwide now to the everything bubble, and I totally believe it is going to melt faces even more so than what it's doing now, because most have not seen the market head up this much. Now, I'm starting with Australia. It just closed in a new all-time high price on the weekly. Canada is closing at a new fresh high, 3% away from a new all-time high. The top 50 in Europe, new fresh high. It's at 23-year highs, nearly at its old all-time high from 2000. UK is also included in that top 50 in Europe. It's about 4% away, so it'd be the lagger out of all of these, but it's still putting in higher lows. Don't even tell me what's going on in Germany. New all-time highs. It's in a technical recession, 7% above its previous old all-time high. Same deal for France, new all-time highs. I know this seems extremely hard to fathom when certain things are going on around the world, and it just doesn't seem right to happen. It doesn't seem logical that these markets should keep going up, but that's why I come back to the 18.6-year cycle. This end stage doesn't seem logical. It's like altcoins. It doesn't seem logical that they boom 100x in some cases for some garbage meme coin that has barely a white paper and some lame marketing plan with a website. None of that seems logical. That's typically what happens at this end stage, because many have seen the market go up for the last 12 or so years with some corrections along the way, and each of the corrections gets met with higher prices. And so by the time you get to this end stage, it's essentially, you're thinking, how can the market ever go down when we've basically beaten everything before? We beat the GFC, we beat the COVID collapse, we beat the crash of 2018. There was a pretty decent crash that came in through here. I believe it was like 15 or 20%. But at the time, it felt really, really difficult. It felt really bad. 2015 also saw a crash. 2011 also saw a correction. I remember that's when I started trading in 2010. end of 2010 actually, and I saw this 2011 crash. A lot thought that this crash was going to be the next leg down after the GFC. That's how bad everything was back at that stage. And of course, that was one of the best buying opportunities that this cycle saw. So what I'm trying to say here is that it doesn't make sense. I totally get it, but the economy has been picking up. Now they're starting to show that in the news headlines. The data's picking up. Things are looking pretty rosy around the world. Now, let's continue on. Italy, new fresh highs. Not at all-time highs, but new fresh highs for this cycle. That's pretty phenomenal. Also, Japan, new all-time high price after 34 years. India, new all-time high price again. This is the emerging markets. This is like your gamble on altcoins. As for the US dollar, it still hangs out here at roughly 103. Now, I've got a simple look here at the prices. If it's able to break back above the 107 level, above that level is strong. That's our 50% of the entire range from that bull market peak down to the low. Now, if it breaks below the 50% here, roughly 102, I dare say that it's got to attempt these two lows again. So that's basically looking like it would come back here and then it would attempt these two lows. So below this major 50% at 102 would be weaker. Now, it's still in this shorter term range here, just trying to hold its head above a couple of 50% levels there, but it doesn't seem like it'll do that longer term. Shorter term, anyone's guess because it's still wedged between a couple of 50% levels, but we're using this over the longer term for the real estate cycle. And we suspect, as we did back here, you can see from the videos in September of 2022, that we're anticipating the market, or the US dollar, to begin to weaken against global currencies. Now for Bitcoin and cryptocurrencies, what we've seen today is a pump on the meme coins. Now I've got here meme coin mania. I hope it's not the dreaded altcoin rotation. Essentially, what has happened in the past is that you get that rotation from meme coins. That's pretty much the end of the line. Sometimes they start to flow into the old garbage projects of 2017, all the stuff that was fancy back then, like stuff you've never heard of, IOTA, EOS, you name it, those sort of things that no one cares about anymore. Let's throw XRP in there as well for you guys. But essentially when that happens, then you start to see that rotation potentially back into Bitcoin and maybe stable coins to take some of these profits from basically degenerate projects. It's okay to be degenerate. There's much bigger gains to be had on these sort of degenerate projects, but just be aware of that rotation as traders look to basically play the beta game by going from Bitcoin, potentially ETH, into your other bigger cap altcoins, and then you get more degenerate down the line into lower caps or basically stupider plays, and that sort of rotates through again. Now this leads me to our traders who are killing the game while these markets are nice and hot, as well as they were during the difficult periods. So it's a good sign from traders when they're making money through difficult periods, because it gets a lot easier during these times that we're seeing now. Now this is all part of TIA Premium, which you can find a link to in the top of the video description, along with the Gann swing indicator, where you can learn how to use the swing indicator to also make yourself some profits in these altcoin markets. Now, of course, there are plenty of educational programs out there across the internet. If you choose to get into this one or other ones, just make sure that the folks who are using the programs, the courses, are making profits from it as well, doing their own thing. Not copy trading, not doing any of that. You just want to learn how to fish, not be thrown fish all the time. Because when you get thrown a fish, if something goes wrong, you don't know how to clean the fish, cook the fish, and eat the fish. You need to know how to catch the fish. And that's the beauty about learning how to do it for yourself. So that's TIA Premium, link in the top of the video description. Let's keep going with BTC, looking at the fear and greed, and also this bull market itself. Now, I've got a couple of points here about the bull market and some of the big warnings moving into this later stage of the cycle. Well, I think more so we're in that middle of the bull market, just based on the amount of excitement that's come back to the market compared to where we were at the lows. The lows, no one wanted to know. We were in here scooping up the bottoms, looking at how the signals were coming in for this to be a low. There was plenty of data suggesting that this was going to be a low. Even the swing indicator was telling us that there is going to be some more strength coming back into the market. That's why I spend so much time on the swing indicator, because it tells you that there is a very likely chance of a change in trend coming. Depending on which time frame you're looking at, that's going to give you an even better signal as to the strength of the move. Higher term timeframes, bigger strength to the upside. Longer time to get in though. So going back to some of these points here that we need to watch out for coming into this bull market, things get more difficult. I think the bear market bottoms are way easier. And I've talked about this multiple times because you can start to see how the market bases itself. You can see that there's a fair significant amount of volume that comes in at these lower prices. And essentially you can start to enter your positions while the masses are not here. It's not as exciting. There's not as much going on. It doesn't seem like it's ever going to come back again, but it's the easiest time to get in. You just have to be so much more patient. Whereas now, obviously you can see things pumping up. And so that's the first point that I want to make here. Bull markets are much more difficult. So if you're feeling like this is difficult and you're feeling FOMO, you're feeling like, when the hell do I get into these markets? Don't be afraid. It's like that across the board. The bull markets are much more difficult because essentially they push and pull you and you've got to try and hang on for the ride. What I like to do, it's not everyone's cup of tea, but you've got to have your own plan in the market, is I like to enter on the pullbacks or early in the trend with confirmation. So that's why we're looking at the pullbacks here. The pullbacks are much easier during the first phases of the bull market. And the bull market for me is measured from the low. We don't measure it halfway up the chart when there's already been 200% gains. The bull market begins from that low point, typically begins with a very big flush out with the capitulations throughout the market. So in terms of that, when do I like to enter? The pullbacks or the early in the trend change. So what could we see here? Well, the trend at the peaks here, there's not much of a pullback. We've looked at that the entire way up. There hasn't been a very significant pullback except for that 21% that came after the ETF. So basically looking at that, it's been a very difficult ride to get in. I'm not trying to sugarcoat it whatsoever. I hope that's what you guys come here for. I don't sugarcoat shit. If you want the people telling you to get into the pumps, you know where to go for that. In terms of playing it safe in the market, typically I like to wait for these pullbacks. Now, getting in on the pullbacks can mean higher prices. That's the price we pay to get it set in a position. Now, the next couple of things here, it's more risky to be out than in during the bull market. They seem like they contradict each other, but the point is, if you want to get in on these runs up, then you have to know that there is a possibility that you'll have to stomach a 20, 30, maybe 40 or 50% correction because there hasn't been a correction on the way up yet. You're basically trying to get in while the market is really hot like it is now. So if you can live with that, if you can live that knowing that there could be a 20% correction coming back from 64 to 50, 51,000, or a 30% correction coming all the way back to 44, 45, maybe even a 40% correction, bringing it back down to 38 grand. If you can live with that, then there's no harm in getting in now. If you can't stomach a 40% correction, then don't do it. You just have to wait for that correction. And that correction could come in a lot higher. Maybe Bitcoin pumps to 80K and then pulls back to the previous old all-time highs at 68, 69, $70,000. It's about getting set and positioning yourselves at the right foundation that works for you. So that's similar to the point here of bull markets will do everything possible to shake out investors. They're going to pump harder than most can anticipate, which is similar to this one here. Markets can remain irrational longer than you can remain solvent. And that's the deal on the way up. They're just trying to shake all of the last buyers into the market, if that's a shake, and then shake out the weak hands to the downside and just look at where that low comes in. And that's what we're looking at when it comes to the fear and greed index. So going back on the chart here, going back in time, there was a lot of shakeouts through this top period. And in terms of the percentages, which I'll read out here so you don't have a ton of numbers in your face, this move to the downside was 30%. It lasted a couple of weeks, but the first shakeout was 27%. That was a matter of 1, 2, 3 days. 3 days, 27%. Not too much changed on the fear and greed here. Get to the next stage of it, which is about 10 days later, then you're basically coming back to the fearful part of the fear and greed index, reading at 40 there. That was enough at that point to reset the market before it ran up again. So this is what we have to expect going into the bull market, looking at these particular points here, where the market's going to do absolutely everything it can to shake out the investors. That's what the bull market is about. That's why we have stressed so much about staying with the bear. Now, to the upside again, maybe it wasn't a good idea making these things black. Let's make it a new color here for you guys. White, 26% to the downside. Again, reset the timing or the sentiment down to 38. market had another chance at a new high. But as you can see, the highs started to get less of a percentage from top to top. So there's a lower percent from here to here, and then again from this one to this one. That's giving us a warning sign that the steam is running out, even though it can last for months. That's January, that's mid-April. It can last for months, still climbing up, but the steam is wearing off. That's what we need to be careful of going into this next phase of the bull market. Now to the downside, this is a 22% to the downside. Matter of 3 days, came back to reset it at 31. So the point here being is we can see 20, 30% corrections in a matter of a few days. There could still be more days to come to the downside, but a lot of that damage is done in the sentiment in the first part, can be done in the first part. And then you have a bit of timing here where the market's trying to figure out whether it's still going to go down. Then you get that dip to the downside, which in this case was 50% for that move. And from the top itself was about 53%. So that was the timing to reset the market sentiment. So going back to that first point, if you can stomach moves to the downside of 20 to 50%, then you're able to get into the market and set yourselves up. But if you can't stomach that, you're going to have to wait for a pullback. And the price to wait for the pullback is that it could be at a higher price compared to where it currently is. That's trading and investing. There's no other way about it. A good thing to note is that we have seen some liquidations here. And we saw one of the highest, or in this case, over the last 3 months, the highest shorts liquidated. $400 million of shorts liquidated a couple of days ago, also along with the longs liquidated. So the beauty about this is that we're starting to see some of the leverage flush out of the market, which allows us to build a stronger base moving forward for this stage of the bull market. You don't want to see a lot of leverage in the market. It ends up being similar to what happened at the peak of the last cycle, where you had FTX basically leveraging up on absolutely every friggin' thing that they owned, throwing it into the markets. And then when they had to unwind, that's what causes the market to fall from that point. But of course, you don't know about that at the peak. That's why we follow the chart. The chart shows us that something is going wrong. Someone is having to liquidate all of their assets because they're basically going to become insolvent. And it's not until the bottom that you find out, oh, it was FTX. They were the ones liquidating their positions through DeFi and Solana and so on and so forth. So that's why keep an eye on this particular one here. Now, in terms of the ETF narrative, a quick one here because we're running out of time. The ETF narrative is a little bit concerning at times. I'm not trying to burst your bubble. Keep your pants on. I know everyone thinks I'm super bearish here, but I try to start it here with as bullish as I can get. These markets are just going absolutely wild. Keep your pants on, people. The ETF now, 29th of February was 92, I think this is in billion dollars inflow into Bitcoin spot ETFs. The previous day, the 28th, which was the day that we saw that huge pump up, this one here of nearly 10%, $5,500 from open to close, that day was the biggest ETF inflow at 673 million billion. You guys correct me if I'm wrong. The point is, it's the biggest one that it has seen since launching, which was at 655. Do note that the following day was still positive. Everyone's going on about how the ETF is just scooping up every single piece of Bitcoin, and it still can. Remember, markets can remain irrational. I'm not an idiot. Markets can remain irrational longer than we can all remain solvent. So we're not trying to call the top. We're not an idiot trying to short each move up. Okay, that is the worst thing that we can do. We can have a laugh at it, but it's very, very sad that people keep trying to short the market and become a hero. Now, on the 29th, we saw $92 million inflow, yet that day was red. And it was an inside day, and it was down. So we saw 2% drop. Not huge, because the day before we did see 9.5%. But if what we're being led to believe is that these big days mean that all this Bitcoin is getting scooped up and it should be positive. If there was 92 million in ETF inflows, that's still more than what they were producing in BTC for the day. Why is it negative? Someone is selling, and that is typical of markets. We're usually led to believe that these things can only go up, especially when this time is different. All I'm saying is just try not to get swept up in that. I love the narrative. I love that things are pumping. I love that Bitcoin's going up. I love that cryptos are going up. All I'm saying is, as a longer term investor, don't get swept up in these narratives as this time is different. Now, if you don't like the idea of the narrative changing on a dime, because good news can turn into bad news as it does every single cycle, then keep your blindfolds on. What I'm here to do is keep an open mind to what's going on in the market, try to make the most amount of money I can from the market, and help you along the way with your journey here in Bitcoin, cryptos, and of course the traditional markets as well, following up on the real estate cycle. Hit the like and subscribe. Check out the links in the top of the video description for TIA Premium. I've got Ethereum and altcoins to cover, but this video is long enough for a Saturday video. I'll see you at the next one. Have a fantastic weekend. We'll be back here on Monday. Take care and peace out.